The trading floor, it's June the 3rd. Some highlights from today's show. Eurozone inflation is now below the ECB target. The US sends letters to key trade partners, and the Eurodollar is primed for a retest of April highs. Good day, traders, and welcome. It's Tuesday. Happy Tuesday. Let's get stuck into it. So I think the key sort of takeaway from yesterday's session was, of course, low volume. Low volume, lots of sideways trade, where the equities at some point felt a little bit vulnerable to the downside, got bought up pretty quickly, and closed the day very, very strong at the end of the day. So it was one of those days where it felt weak at some point, it felt strong at some point, and it very much closed strong, but everything on low volumes. Okay, yesterday across the board, whether it was bonds, whether it was currencies, whether it was equities, it was relatively light volumes, and that's to be expected in a week when, of course, we have got all the key hard data coming out, starting, of course, with the JOLTS data, which we'll get into in a moment. Now, with that in mind, let's get stuck in and talk about our first topic for today, and it's very much about the inflation print that's come out of Europe. A tad on the weak side, a miss on both the headline and the core. Now, this on its own is not necessarily market moving, but ultimately what it does point to is a scenario where the ECB will definitely be cutting come Thursday this week, but it does sort of open the door to the question about what comes next from the ECB. Now, we know there's a lot of debate going on in the ECB. The hawks are talking about this idea of higher inflation coming in the near term towards the end of this year, of course, as we start to see some of the tariff implications filter through, where the doves are saying, well, look, at the end of the day, we've got very, very low growth, and ultimately we do need to be supporting the economy quite a great deal more. Now, I tend to lean on the camp of the ECB, and Europe in general has always failed to generate any kind of inflation, and that was when we had interest rates pretty much at zero and even negative. And the result is, of course, now we have interest rates substantially higher, and the ECB seems to think that they are nearing that point of neutral, if not already at that point of neutral after the cut come Thursday. So look, a lot is to be seen, and it doesn't really matter what my opinion is. It matters ultimately what the ECB's guidance is going to be. Now, we'll talk a lot about the ECB as we move into the Thursday meeting. Of course, we will prepare for that with the daily market rundown. But the key takeaway from ultimately today is to understand what are break-evens doing in Europe, but then also what is the currency doing? Because I think therein lies a key opportunity for us as traders. Now, the first thing to discuss, of course, is what you can see on screen is the Schatz in purple. That is the German 2-year bonds. And then, of course, the break-even inflation expectations, 5-year in the orange. In other words, what is the expectations for inflation looking out 5 years? Now, the ECB typically wants to keep this orange line somewhere in a box between 1.8 and 2.2. That's kind of their goal, is to really keep it anchored. You hear this word anchored quite a lot in the medium term. Now, the reason we use the 5-year is because that is a good reflection of the medium term. It's also something Mario Draghi pointed out in 2014-15 before they began the process of very aggressively cutting rates to the zero bound, and of course beginning the process of QE. So it is something the ECB pays very, very close attention to. They do watch it very closely, and it was once we got below that 1.8 that, of course, the ECB panicked back in 2014. So that's why we pay attention to it. Now, you can see it's well anchored. It's pretty much right at the ECB's target. So there's really nothing for the ECB to be panicking about right now. Policy is very, very well calibrated. I think that's the key takeaway. And it's not like we expect anything out of Thursday. I don't expect the ECB to be dovish. I don't expect them to be hawkish. I expect them to follow the line and ultimately signal that they could continue the process of cutting should the data warrant it. But for now, they are likely to pause and assess the incoming data. Okay, that's very much going to be the message. But what is key now ultimately is to watch what the break-evens do. Why? Well, because ultimately what the market is going to now do is it's going to respond to whatever the ECB tells us. In other words, if the ECB was to come out and signal perhaps further rate cuts, well, the break-evens may respond to that. They may actually then go and say, well, hang on a sec, if you are going to cut even further, maybe inflation expectations need to be higher. Okay. Equally, if they were to pause, and we suddenly start to see those break-evens drop off, ultimately the market is signaling that policy is still too tight and perhaps the ECB must do a little bit more before they get towards that point of neutral where they're no longer restraining the economy. Okay. What does this all mean? It means we watch break-evens. Okay? It means we go into that ECB meeting with an open mind. We expect not a great deal, but we watch those break-evens and how they respond. Now, the reason we have the shats up against it is because you can see a near perfect correlation between the shats in terms of yields and break-evens, and ultimately this is why we do see the charts together on the chart. Okay, now, one thing to point out, and I think this kind of ties into the story of why I think the euro is starting to show some real strength, is ultimately if you look at what has happened in the currency space year to date. Now, we know it's been a theme of sell dollar pretty much all year, particularly since we had the Liberation Day. That theme hasn't gone away. Okay, despite the fact that we have all these extensions and tariffs being scaled back aggressively, the reality is that dollar is still down 8.5%, and it's primarily against the risk-off nations, the real sort of traditional safe haven assets or currencies like the Swiss and the yen. We can see there we have got 10% gains for both Swiss and yen, and then the other best performers, of course, the euro. Okay, now this is unusual, somewhat unusual. The euro, of course, has never really been a pure safe haven play, but simply because this year we've seen a lot more sell side action in the US bonds and in particular US assets and the underperformance in US assets, we're now seeing Europe becoming somewhat more of a safe haven option. Okay, it's a diversification against the US. And what this points to is ultimately that the euro at some point, when we get the next bit of risk off, or ultimately when we see that dollar continue to trend towards the downside, the euro is going to be a primary benefactor of those outflows of the US dollar. Okay, we can also see that the pound has performed somewhat better, and again, this is because of the fact that they do have relatively high interest rates against the rest of the world. And on the bottom side, we can see obviously Australia. Why? Well, because they're very closely linked to China. Okay, the point is that the euro is one of the best performing currencies this year against the dollar. And so for that reason, I'll talk about the euro chart in a minute, but it's for that reason that contextually the euro is now starting to prime itself towards a move back up towards April highs. Okay, we also had some news from the OECD, and I think this is interesting. You can go and take a read of this. I think the key takeaway is they've downgraded the US economic growth to 1.6% from 2.2. Originally they had it at 2.2 for this year. It's now down to 1.6, and then ultimately they've downgraded next year to 1.5 from 1.6. Now, why does this matter? Well, because we now have this idea that the US government's going to run a debt to deficit or deficit to GDP around 7 to 8% for the next 2 years, and the administration is telling us that this big beautiful bill is going to create so much growth that effectively growth will outstrip the debt, and that's how they're going to service the debt in the long run. The reality is the OECD is saying the complete opposite, okay, which is we're not going to quite see this ramp up in growth. If anything, we're going to see slow, sluggish growth over the next 2 years. Okay, now this is very, very unusual for a US government to spend this degree of deficit spending at a time when things are okay, the economy is okay. Really does point towards what we've been talking about for a while, which is there is a nosebleed moment coming for the long bonds. Okay, it is gonna, all but almost guaranteed, we are going to see a staging event in the bond markets at some point. Okay. Now, our job as traders is to sit there. It's just to sit there, wait, become opportunistic, wait for those long bonds to puke above 5.10 in the 30-year, and then take advantage of it. Okay, now, will it happen today? Perhaps not. Will it happen on Friday with non-farms? Perhaps. We just don't know. What we do know is that right now, growth is not looking as robust as what the US administration is telling us. And so what that means is that if they're going to pass this big, beautiful bill, ultimately that is going to prove to be very, very inflationary. It is going to prove to test ultimately the bond vigilantes, and they are going to put some sell-side action into those long bonds. Okay, interesting article. Now, the other article that's come out is this US pushing countries for their best offers. I think it's interesting. The markets don't really care too much about it for obvious reasons. We got 5 weeks to go to the deadline before reciprocal tariffs are supposed to kick back in, and this just looks like a last-ditched effort from the administration to kind of just get trade talks underway. Okay, now, contextually, I think what matters here is that they've sent letters to a number of key trade partners. They've said, look, tell us what your best offer is. And then based on whatever your best offer is, we'll send you a number and that's your tariff. Okay, now this sounds somewhat kindergarten-like, where, you kind of let someone else say, well, we'll give you this, we'll give you this, we'll give you this. And then the US says, okay, based on that, we'll give you 15%, or based on that, we'll give you 30%. Okay, yeah, fine. It's being termed as a quick way to get to an endpoint, but it just seems to point to something a little bit more important, which is that the US administration is ultimately buckling under this idea of 90 days being sufficient. Okay, they've almost put themselves in a corner now where they've said, look, we're going to give everyone 90 days and we're going to do deals over the next 90 days and then ultimately we'll move from there. The reality is they are not going to get everything done within the next 5 weeks, and that's why they're trying to just speedily, hastily kind of get to some sort of outcome in the next 5 weeks. Okay. What does it mean for markets? Nothing. But what it does mean is that at some point, if we see a lot more dragging of feet, we are going to see some sort of escalatory type commentary as we move into that July deadline. Okay. We, of course, don't forget, are waiting to hear from China. They've actually not confirmed whether or not Xi Jinping will speak to President Trump this week. We know the US administration is very positively pointing out that they are going to have talks this week. They are going to hold talks. And the Chinese have purposefully not commented on that yet. So we need to find out, is that talk going to happen? If the answer is no, if we see the Chinese government come out and say, nope, those talks are not going to happen, we'll probably see a little bit of a knee-jerk reaction to the downside, a little bit of risk off, but nothing that's going to suddenly turn the tide for the markets. Okay, now with that in mind, our key chart is the euro dollar. A few things to point out. If you go back to last week, Thursday, we had this key auction reversal. I think that matters a great deal, simply because of not just the day itself, but where it pinged off of. Okay, it was that 112 level that we know was some significant resistance, not just in August, September last year, but also earlier last year, and of course in 2023. Okay, we also know that when we did ping through there, we had a very significant stop run day through that level. It has acted as quite an important gauge for the markets. Now, from that point, I think what's key to take away is note the one-time framing that has begun. The process of one-time framing where we make higher lows and higher highs. That process where buyers are very firmly in control, but more importantly, we've now taken out those May highs, and we've closed above those May highs yesterday. So there's a lot of positive bullish signaling coming out of the euro dollar. And like I said, I do expect this is going to trade up to that 116 in the near term, perhaps today / tomorrow into that non-farm payrolls. I do expect ultimately, if we get even just a little bit of weakness in that jolts number, it is effectively going to jolt that euro up toward the daily highs. Now, the approach here is not necessarily to buy the top tick. The approach is very much to buy the down ticks, fade ultimately any kind of sell side action, buy the dip. That is the strategy in the euro dollar. And if we go and have a look very importantly at some of the moving averages, something very key happened last week, which is we've now got a very, very steep 50-day moving average. Of course, we can see the market consolidating in the near term with that 20-day moving average just moving sideways, a little bit of catch up. We can also see that 100-day is now crossed over the 200-day. So it's very much a market that's firmly to the upside. The trend and the technicals are pointing to the upside. And importantly, today we had a miss in inflation, and yet the euro is most likely going to close with that one-time framing sequence in play. In other words, right now, ultimately, even though the ECB is going to cut one more time, the markets are looking at the fundamentals saying, well, it doesn't really matter right now because there's quite a significant demand for the euro. Okay, so contextually, fundamentally, technically, the euro has got a lot of upside potential. I do think we're going to get up to that 116 level over the course of this week. Okay. With that in mind, of course, key data today, it is the US JOLTS number. It's the first bit of hard data we need to pay attention to for this week. As we can see, it has been trending down quite a lot. We're expecting a 7.1 million print. Now, what to pay attention to today is ultimately almost this bar chart at the bottom here. And what you can see effectively since the Fed began that very aggressive hiking cycle is that we've only had 3 instances, 1, 2, 3, where we've actually had the JOLTS number pick up month over month. In other words, we've had an increase in the number of job openings available. Okay. Now, the key takeaway for today is that we are expected again for another negative print, about 100,000 jobs on the job openings. But it's the degree, it's the magnitude of drop today. Okay. If we get something less than 7 million, it is going to open and create a little bit of a head scratcher situation where we've seen another 200,000 job openings disappear. It doesn't suggest anything in terms of a recession, but what it does suggest is that perhaps we're not seeing that stabilization in the job openings. Okay, now remember, the labor market has been softening. We know it's been softening. We know it's still pretty good, but at some point, the Fed is going to want to see some stabilization in the job openings. They don't want to see this, sort of nosedive to the downside. They want to see it start to just taper off, okay? Because otherwise, it starts to indicate that perhaps policy is a little bit too restrictive. Okay, now don't forget, We are one data point, and I'm going to keep stressing this, we are one bad data point away from the Fed very much bringing forward a rate cut. Okay, what does that mean? Well, look, if we got a 55 or a 60,000 non-farm payrolls print on Friday, you can bet your bottom dollar the Fed's going to be cutting rates pretty soon. Okay, that is the reality of the situation. As much as they talk tough on inflation, the reality is they have got a dual mandate, and that very much includes the labor market. Okay, so with that in mind, keep a close eye on JOLTS. Anything less than 7 million is going to create a little bit of sell side action in the dollar, perhaps a little bit of a sell side action in the risk markets, but nothing that I expect is going to derail this trend. And that brings me to our play of the day. It's very much in the ES today. It's very much a profile play, which is if you go and have a look over the course of the last couple of sessions, these little red bars here, you can see that for the last 5 sessions, that VPOC, that point of control where the market has kind of oscillated around for the last 4 sessions, is sitting around that 59.05 area. Okay, you can even see it marked out there, 59.20 from the consolidation. But that 5900 to 5915 is a real block of acceptance. The market is quite comfortable with that being fair value until we get some significant change in the dynamics. But what I do expect is that this day here that we had, of course, last week, I expect some sort of a fill out. Of course, we know that 6,000 acted as quite a significant little bit of resistance, but I do expect we're going to see just some sort of a test. It's very unusual to have that sort of a distribution that doesn't get tested. So for me today, it's very much buy the dip around that 59.05s, looking for at least a fill of yesterday's cash close. Don't forget that was quite a strong cash close yesterday, so I do expect 59.50s trade again today. Got about 45 handles of upside there, roughly around a 0.8% move to the upside, and not going to cost you a great deal. Okay, I don't expect the buyers to give up the 5900 without a fight, so I do expect quite a bit of price action response off that 5900. And then, like I said, I think once we scale above yesterday's highs, it's very much going to inch its way. It's not going to be a straight line bid through. It's probably going to just grind its way up towards that 6,000 level. And then, of course, we know that is quite an important point where I do think the market's probably going to struggle for a number of days until we get some form of a catalyst. Okay, with that in mind then, of course, like I said, there's a number of things going on. There's a number of key headline risks to pay attention to, but it is going to be muted until we get to that JOLTS data. If the JOLTS data comes in line, don't forget there are far more important things this week for the market to pay attention to, and unfortunately, it only is going to start around Thursday. Okay, that is the key takeaway. It's very much going to be, keep your powder dry. Don't be too aggressive in the markets until we get to some of those key data points later on in the week. With that in mind, if there are any questions, do post them in the Discord channel. For those of you on our channel, tell me what's your play of the day. What's your trade of the day? What do you think? What do you think is a good trade opportunity with good risk reward? Post that in the comment section, and of course that makes it available for everyone else to have a look at. Otherwise, good luck out there. Manage the risk. Go make some money.